A lot of people think Palantir just delivered another very strong quarterly report. Revenue surged, profits doubled, orders exploded on the surface. It looks almost perfect. But the real question is this: when Palantir is running at this kind of speed, is the market preparing to reprice it, or is it starting to hesitate over whether it's actually worth this valuation? Welcome back to Deep Dive Stock Earnings. Today we're focusing on one company only, Palantir, ticker symbol PLTR. Let me be clear from the start, this is not an emotional earnings recap, and it's not about telling you whether to chase the stock. What actually matters is that after this quarter, Palantir has moved from telling an AI story into a phase where the market is actively reassessing how it should be priced. And that's where the real disagreement begins. If you just look at the surface level numbers, Palantir's quarter is almost flawless. Revenue came in well above expectations. Profitability hit a clear inflection point, and the company generated close to $500 million in net income in a single quarter, a step change compared to the same period last year. More importantly, this wasn't driven by one-off projects. It came from simultaneous expansion in scale and improvement in margins across its core business lines. For a software company that had long been criticized for burning cash and lacking consistent profitability, this wasn't just a good quarter, it was a structural shift in the business model. But precisely because of that, the question becomes more complicated. When Palantir's strength is no longer a surprise and instead becomes a baseline assumption, the market stops asking whether growth exists at all. Instead, it starts asking whether that growth can continue to be valued using the same valuation framework. What's really driving this shift isn't the legacy business, but the acceleration in Palantir's commercial customer segment. Core commercial revenue post-explosive growth. New contract values expanded dramatically, and remaining performance obligations continued to build rapidly. These numbers send a very clear signal. Customers are no longer just running pilot programs, they're committing to long-term, system-wide deployments. That means sales cycles are shortening, contract sizes are increasing, and revenue visibility is improving significantly. This step determines whether Palantir can still be viewed as an early-stage story stock. Put simply, Palantir is no longer in the phase of can this be used. It has entered the phase of is this worth rolling out at scale. And that's exactly where the market begins to split. Because once a company enters large-scale monetization, the valuation model has to change with it. That's why the market has started to focus so heavily on Palantir's operating efficiency metrics. When growth rates and profit margins rise at the same time, it signals a self-reinforcing business model. But the problem is that this kind of velocity is extremely rare. In the software industry, when it does appear, the market instinctively asks one question: is this Palantir's new normal, or is it a temporary peak? As a result, even when quarterly results remain strong, the stock price begins to hesitate, rather than immediately pushing higher like it did in earlier stages. So, what you're seeing now isn't the market losing faith in Palantir. It's the market waiting for more confirmation, not waiting for revenue to collapse, but waiting to see whether margins and execution can hold as scale continues to expand. What supports Palantir's high growth isn't just abstract metrics, but a growing number of real-world deployments across large organizations, complex operations, and automated decision-making workflows. The platform is moving from being an analytics tool to becoming a decision-making core. Once enterprises begin relying on Palantir in mission-critical processes, switching costs rise quickly, and that's where long-term pricing power comes from. This is why orders are not a one-time spike, but continue to accumulate over time. But the market doesn't immediately assign a premium valuation just because the story is complete. It always asks one question first: does this level of growth justify applying a higher multiple to future cash flows? And until that question is answered decisively, hesitation in the stock price is not irrational, it's logical. When you look at the stock price itself, you'll notice something interesting. When positive news appears, Palantir stock is no longer chased aggressively higher. When skepticism appears, the price doesn't collapse either. That tells you the core of the trade is no longer short-term performance, but an ongoing negotiation around long-term valuation ranges. Capital isn't rejecting Palantir, it's recalibrating. Until confirmation arrives, investors would rather move sideways than fully price in maximum expectations. So in summary, the real disagreement around Palantir right now isn't whether growth exists, but how that growth should be priced. The earnings results are already strong. What still needs to be validated is whether that strength can remain consistent over time. If you were looking at Palantir at this point, would you be more concerned about valuation running ahead, or more confident that its commercial model has truly been proven? Let me know your thoughts in the comments, and I'll see you in the next video.